Hey Bowtie Nation, Joseph Hogue here, and 2 years ago I showed you how to use monthly dividend stocks to pay your rent, and it was immediately the most popular video on the channel. Since then, home prices have surged 45%, and the increase in interest rates have added $1,000 to monthly mortgage costs. So you picked a hell of a time to buy a house. But if you are tired of living in that studio apartment below a bowling alley and above a Chinese restaurant, I've got a video for you because I found 7 monthly dividend stocks that will pay your mortgage. As with that last video, we'll break these down by state to show you the average monthly mortgage in each. So if you're one of the last 3 people living in California, stick around for a 14% yielding stock to pay the bills. First up here, if you live in Arkansas, Indiana, Mississippi, Alabama, or Kentucky, that average mortgage of $1,128 a month comes with an extra bonus, something no home should be without, a mattress gun rack. That's a $40 value right there. And okay, before I get 1,000 comments about how you can't buy a cardboard box in a crack alley for $1,100 a month, please forward all complaints to Statista, P.O. Box. Let's just move on, okay? The monthly average they're quoting here doesn't include insurance, taxes, or evidently standards, but it's the most current I could find. Paying for your old Kentucky home here is the most popular monthly dividend stock, Realty Income, ticker O, and it's 5% dividend yield. And that 5% yield may not seem like much, but it's going to surprise you with the stock's history of dividend increases. Realty Income is the only real estate investment trust in the Dividend Aristocrats Index and has posted 117 quarterly increases, a growth rate of 4.6% annually since 1994. In fact, if you had bought the shares in 1994 at that $8.30 each, you'd now be collecting $3.06 a share in dividends each year, a 36% yield on your original price. While most of the company's properties are in retail, it's all in that defensive side of the industry with convenience stores, groceries, and drugstores, the kind that aren't being replaced by e-commerce. That means stable cash flows and a vacancy rate average of 98%, well above the REIT average at 94% vacancy, producing that consistent income. To add a little growth to the portfolio, the company has started acquiring gaming and resort properties with its Wynn Resorts deal. It's a little more cyclical compared to those defensive retail properties, but adds some great cash flow growth to the stock. Real estate stocks have had a tough time with those rising interest rates, and the industry is down 25% over the last year. That makes it a good time, though, to start adding those shares of Realty Income ahead of what could be a strong bounce when the Fed does start lowering rates. While you might not be able to cover all your monthly mortgage with dividends at first, given these dividend increases, it might not be long. It's going to be a little more expensive if you live in Idaho, my native state of Iowa, Missouri, New Mexico, or Louisiana with an average mortgage of $1,250 a month. And here, I actually looked up what you get in Louisiana, assuming a 7% interest rate on a 30-year loan. It's about $187,000. And this adorable waterfront home, formerly home to a well-known football legend. It comes with Christmas lights up all year long and a free banjo. Not only does Main Street Capital, ticker MAIN, pay a 6.75% dividend yield, but the stock price has more than doubled over the past 10 years. It's not the highest dividend on our list. That one I'm saving for the New Yorkers paying $3,000 for a studio apartment. But the dividend and the price on this has produced a 12% annual return for a decade, making it a great investment to pay your bills. Main Street is a business development corporation specializing in loans and equity investments into mid-sized businesses. The company has regularly increased its dividend, now up 105% since the 2008 IPO, and often even pays a special dividend. Main Street has 182 portfolio investments as of the most recent quarter, with the largest representing just 3% of the total fair value. So a hit to any of these one investments isn't going to hurt the shares that much. The weighted average yield on the portfolio of loans is 9.6%, so well above that dividend yield, giving this one sustainability and room to grow. In fact, and this is amazing, if you had invested $150,000 in Main Street 10 years ago, you would have collected almost $1,200 a month in dividends to pay your rent, and would now have enough to pay off your house 20 years early with $64,000 left over. Folks, that is the power of these monthly dividend stocks with those increasing payments. You may not be able to cover all your mortgage at first, but between dividend increases and stock return, it's going to put a big dent in your payment, and you'll be able to pay off your mortgage early. We're highlighting some of my favorite monthly dividend stocks here, but if you want to see my top growth stocks, Look for the link I'll leave in the description below for a free report, my forever stocks, the stocks I'm buying for the next 30 years. Check that out with the link below. It's totally free and helps support the channel, so I appreciate that. We're moving on up into Ohio, Michigan, North Carolina, Kansas, and Nebraska for an average mortgage of $1,308 a month. And I kind of felt bad ragging on Ohio or Michigan here. I mean, it's like Mad Max times there already, so let's be nice. I did, though, find this beautiful 4-bed, 2-bath in Cleveland. It comes with the standard Cleveland security, an electrified razor wire fence with motion detectors, a Rottweiler, and a moat. We're up to over 7% dividend yield with shares of Gladstone Investment, ticker GAIN, and a stock price that has doubled in the past decade. And why I like GAIN here is because it takes a higher equity share than most other BDCs. Now remember, those business development corporations, they're mostly making loans, so that upside is capped at that interest rate. But Gladstone's target investment is 25% equity and 75% debt versus a traditional BDC that's going to look for less than 10% equity in the companies they work with. That higher equity ownership might mean higher risk, but it also is going to mean those higher returns on those investments. And we see that in GAIN's history of a return on equity, which is well above the industry average. The 5-year average ROE of 17% is over 3 times the median ROE for that BDC group. And even though that near-term return has come down, it's still well above the average for the group. Gladstone's current portfolio is spread across 28 companies in 14 industries, so a level of diversification there that should help it continue those returns even in a sluggish economy. The shares have done so well, in fact, that it's been able to pay out multiple special dividends, boosting that cash return. We're halfway through now with Maine, Georgia, Montana, North Dakota, and Arizona with an average monthly payment of $1,387 a month. And I did find something in Montana for that price. It wasn't difficult. It's the only house in Montana. We're into those double-digit yields here with Gladstone Capital Corporation, ticker GLAD, and its 10% dividend yield. Now understand, with these higher yield dividend stocks, you're not going to get as much price return while you hold them, but that higher yield does mean it's going to take less investment to make your monthly mortgage payment. For example, the home value for that $1,387 monthly payment works out to about $210,000. But you'd need to invest just $150,000 at that 10% yield for the dividends to totally cover your mortgage. Gladstone is another business development corporation, and something you want to check out in these is that diversification of loans across industries. Gladstone makes loans across 17 industries, with nearly a third in relatively stable groups like healthcare, education, aerospace, and defense. Now that diversification is important here for that cash flow stability, so no one industry accounts for a big portion of those loans. The weighted average yield, the line here in the chart, is the average return the company makes on its loans, and you can see here it was far higher before the pandemic. That average yield on loans was over 11.6% in the 5 years through 2019 versus just 10.5% this year. Now, as rates increase though, and the company gets that average yield back up, that cash flow is going to return, and both of the shares and the dividends could increase. Now, we haven't quite seen it yet, but I'm wondering if BDCs can do really well this year on that banking crisis. Regional banks have historically been the primary lenders to local small and mid-sized companies, but with that bank crisis, those lending standards are tightening up. That could mean a rush to BDC lenders to fill the gap for those higher loan demands and higher interest rates. If you live in Florida, Nevada, Minnesota, Delaware, or Illinois, your average mortgage could be around $1,542 a month. We just moved to Florida last year, and the upside here is that every home comes with a year's supply of SPF 1000 sunblock and gator repellent because it is the only way to live down here. Paying for your mansion in Gator Alley is Pennant Park Floating Rate Capital, ticker PFLT, with its 10.5% dividend. Pennant specializes in floating rate loans, something that could help it increase its yield as interest rates rise. 87% of the portfolio is in secured debt on first liens, with another 13% in equity investment to give it even more upside growth. That high percentage of loans with that first lien status is going to help it protect in a downturn in the economy, while that high equity position should help it rebound further. The company's current portfolio of loan to 105 companies is diversified across more than 30 industries, with an average loan size of about $10 million and a 10% average portfolio yield. Now, you don't get much dividend growth with Pennant, though it has doubled the dividend since 2011, and unlike a lot of these BDCs, It tries to keep that dividend payout stable so you know what to expect in that yield. We're starting to get expensive here, living in Colorado, Alaska, New Hampshire, Maryland, or Connecticut, with an average mortgage of $1,917 a month. But as a bonus, every home sold in Alaska comes with its own reality show about rednecks that move to Alaska. Eerily ironic here, paying for that Alaskan prospector's getaway with Prospect Capital Corporation, ticker PSEC, and its 10.4% dividend yield. Prospect is a BDC founded in 2004 with over 16 years of dividends and performance. The company manages a $5.7 billion portfolio of 122 investments in companies across 37 industries and earns a 9.9% yield on its portfolio. Now, that's just slightly below the dividend yield, but the company has plenty of liquidity to cover the cash return as the portfolio yield increases. In fact, Prospect has returned a cumulative $20 a share in dividends for more than $3.8 billion since that 2004 IPO, and that payout keeps climbing. That is the purpose of these BDCs, to act as a bank and an investor to mid-sized companies, manage those assets, and then return 90% of the earnings as cash flow to you, the investor. We're coming up on the most expensive mortgages and the stocks to pay for them. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign up link below. You can still live in New York, Massachusetts, California, Hawaii, or New Jersey for an average mortgage of $2,270 a month, and I can prove it. That's about $302,000 on a 30-year loan, and I found this lovely 740 square foot home in Brooklyn. It's yours, and all you have to do is remove the chalk outline the police left on the floor. Helping pay for your dream home is AGNC Investment, ticker AGNC, a mortgage REIT with a 14.5% dividend yield. With that high a dividend yield, you need to invest just half of what the house costs to make those payments. Investing $188,000 at a 14.5% dividend yield pays that mortgage on a $300,000 home. Now, this mortgage REIT is a special type of real estate company. These REITs borrow money on those short-term rates, then leverage that up, borrowing 2 or 3 times as much to invest in long-term mortgages. Here you see the interest rate on repurchase agreements, a special overnight short-term rate many mortgage REITs use. And you can see it's been almost nothing for much of the last decade. So then they use that borrowed money and other capital to invest in those mortgages with those higher rates. So if you take out a 4 or 5% interest received on a 30-year mortgage minus the near zero rates they're paying on that borrowed money, it's been a very profitable business and great dividend cash flow. AGNC holds a $61 billion portfolio of these mortgages, 91% of those in 30-year fixed terms, and most of those on safe agency-backed mortgages. Now, 2 things you do need to watch when investing in these mortgage REITs like AGNC, though, is that book value per share and the net interest spread. Now, book value on the left here is the value of the mortgages the company holds, and you can see that this has dropped consistently since last year as those interest rates increase. Now, the problem with that is those higher interest rates means the older mortgages and bonds are worth less because they're going to pay that lower rate than newer mortgages. For example, the rate on a 30-year mortgage has doubled from under 3% to over 7% recently. So anyone holding those old mortgages as an investment, the portfolio just isn't worth as much compared to new bonds. The good news here, though, is that the stock is trading for a significant discount to that book value. Here you can buy shares for $10 each, a 20% discount to the actual value of the mortgages held in the portfolio. Now, that discount to book value is always a great place to start when you're buying these mortgage REITs. But another bit of good news here is that net interest spread on the right. That's the difference between the interest the company pays on its borrowed money and what it collects on new investments. You can see that profitability is growing higher. So once interest rates level off or stop increasing so quickly, this could again be a great cash flow stock. Get your free report, My Forever Stocks, with the link below, or click on the video to the right and get your dividends every week. I'll show you the stocks to buy each month for weekly cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.